If you're thinking about buying a home in 2025, you need to know about FHA loans. These government-backed loans make homeownership more accessible, especially for first-time home buyers. In today's video, we're going to cover the 2025 FHA loan limits, the qualifications to get an FHA loan, and the different FHA loan types that are available. So let's dive in. What are the FHA loan limits for 2025? Every year, the FHA will set its loan limits based on local home prices and the local markets. So here's what you need to know for 2025. There are two basic ranges. There's the low cost areas and the high cost areas. So in low cost areas, the minimum FHA loan limit for 2025 is $524,225 for a single family residence. These will change based on if you're buying duplexes, triplexes, or fourplexes, all of which you can get and qualify for an FHA loan on. In the high cost areas, in areas like Orange County, California, where I'm at, we're considered a high cost area. The loan limit goes up to $1,209,750 for the single family residence. Now, as I told you, you can qualify for an FHA loan on any property 1 unit to 4 units, as long as you live in that property. So the taking Orange County prices, the loan limits start single family, the $1,209,750. But for 2 units, you can go to $1,548,975. For the 3 units, you can go up to $1,872,225. Fourplex, you can go up to $2,326,875. You can check your county's specific loan limits on the FHA website. Let's talk about what qualifications are needed for an FHA loan. Now, FHA loans are known to be useful for people with lower credit scores and people who want to put down lower down payments. So as far as credit scores go, a 580 plus credit score means you can put down 3.5%. That's the only 3.5% is required. You can put down more. If you have a 500 to a 579 credit score, you're required to put down 10%. An example of why a higher credit score gets you better terms on any kind of loan. Now, certain lenders that do FHA loans have lender overlays and they may require more down payment based on your credit score. But those are the limits set, those are the qualifications set by the FHA. Now, as far as the down payment, again, you can go as low as 3.5% if you have that 580 credit score. More importantly, where can the down payment come from? You have a couple options. These can come from your personal savings, family gifts, or down payment assistance programs that you can use in conjunction with an FHA loan. Now, the debt to income qualification for an FHA loan is typically maxed out at 43%. This is where you take your gross monthly expenses and divide it by your gross monthly income. And this would include, your expenses would include the new mortgage payment on the house. And if you exceed 43%, you may not qualify for an FHA loan. If you're under 43%, you're good to go. Employment and income requirements for an FHA loan. You just need to show a steady history of employment, at least 2 years. Now, these 2 years don't always have to be with the same employer, but being in the same industry is beneficial. What you don't want to do is you don't want to be changing from a W-2 position to a self-employed. That's you taking on a greater risk, and a lender's not going to like that. In order to show this history, you're going to show your pay stubs, W-2s, and tax returns, and typically bank statements as well. The biggest requirement on FHA loans is that it is a primary residence. Now remember, you can buy up to 4 units using an FHA loan. However, you need to be living in one of those units. FHA loans cannot be used on investment properties, solely investment properties. It's like mortgage insurance on FHA loans. There's actually 2 types of mortgage insurance with an FHA loan. There's the upfront mortgage insurance, and then there's the annual mortgage insurance. The upfront mortgage insurance, UFMIP, is typically 1.75% of the loan amount, and this is going to be rolled into the financed amount on the loan. And don't worry, we're going to do an example of this in a minute. The annual mortgage insurance can range anywhere from 0.45% up to 1.05% of the loan amount. And this is added to your monthly payment. An important note about FHA mortgage insurance is that it typically lasts the life of the loan, which means even after you achieve 20% equity, you will still continue to pay that annual mortgage insurance premium on top of your payment, unless you refinance out of an FHA loan into a conventional loan. So if you end up wanting to use an FHA loan and get out of that mortgage premium once you achieve that 20%, just know that you will need to secure a refinance at that time. So let's go through an FHA loan calculation so that you can figure out how much mortgage premium you're going to be paying. For this example, let's take a $300,000 property. Let's put down 3.5%, so $10,500. That's going to make your base loan amount $289,500. The upfront mortgage insurance, remember 1.75% of the base loan amount, is going to be $5,066. That means your final loan amount is going to be $294,566. Basically, purchase price minus the down payment plus the upfront mortgage cost, and that's the total amount you're financing on the loan. Always speak to a lender and ask them any questions and have them give you a rundown of any potential cost associated with whatever loan you're going to use. So now let's go through some different FHA loan types. There are different types of loans from the FHA that you can use for different purposes. The FHA home purchase, a straight purchase of a home, is the most common. And again, it's used for people who want to put a lower down payment or may have a lower credit score and need the easier qualifications. The FHA also offers a refinance option, and this is for people refinancing one FHA loan and just refinancing with the FHA loan, which allows them to streamline it and make it a little easier to get the refinance done. Then there's an FHA 203K loan. This is the rehabilitation loan. This is if you are buying a fixer-upper and you know it's gonna need work once you purchase it. You can actually roll in the construction cost into the complete loan so that you can still purchase the home and then start work on that property to bring it up to standards. The FHA also offers reverse mortgages for people who are 62 years and older, allowing them to cash out equity on their home later on in life. So the FHA offers a fantastic opportunity for people who may not be able to save up that much for a down payment, but want to get into the home purchase. 3.5% is a far cry from 20% down. Out here in Orange County, when that loan limit goes up to 1.2 million, and taking 1.2 million, if you wanted 20% down, you're talking $240,000 to meet the 20% requirement. So having an FHA loan option where you only have to come up with 3.5%, in this case it would be $42,000, that's a big difference, and you can achieve home ownership a lot earlier. Remember, you're just gonna have the added cost of mortgage insurance placed on the upfront and placed on the annual and your monthly payment. FHA loans are also great for people with lower credit scores that may not qualify for conventional loans or may not qualify with most lenders. It allows a little more flexibility. So again, FHA is a good loan option for people who want to get into home ownership, may not meet the credit score qualifications, or may not want to wait till they can save up 20% of a down payment for a home. If you found this video helpful, please hit that like button, subscribe to our channel, and let me know any questions you have in the comments.